Protests broke out across the country following George Floyd's death in Minnesota, after a police officer there knelt on his neck for 8 minutes and 46 seconds. As the Black Lives Matter movement brought thousands upon thousands into the street, company after company tried to show their support on social media. They blacked out Instagram and condemned police brutality and racial injustice. Consumers and activists soon called them out with their own social media campaigns, with hashtags like #OpenYourPurse and #PullUpAndShutUp. And some companies did. They announced big initiatives with big price tags. Bank of America announced a $1 billion plan to assist communities of color impacted by the coronavirus pandemic. Cisco donated $5 million to a number of organizations fighting racism. Millennial makeup company Glossier pledged a $1 million donation to organizations and Black-owned beauty businesses. Nike committed $40 million to the Black community over the next 4 years. Nike, though, soon faced criticism for a lack of diversity among its executive ranks. Before the death of George Floyd, and before COVID-19 forced corporate America into lockdown, companies were being singled out on the basis of corporate responsibility, either for a lack of it or for a commitment to progressive ideals. It's a trend that began to accelerate well before the current demonstrations and pandemics. It's just now gone mainstream.
So it's gone from something that is looking at policies and procedures to something that is looking at real-time behavior as it plays out in front of us.
This all falls under what's known as ESG investing, which stands for environmental, social, and governance. It's a catch-all term for socially responsible investing. Here's how ESG investing could change Wall Street and the business world. Environmental, social, and governance, socially responsible investing, impact investing. A lot of terms come up when we think of ESG investing, and it can get confusing. So we're going to let the experts define it for you.
Well, the way we think about it at Bank of America is it basically boils down to environmental, social, and governance considerations that are part of the panoply of considerations that we as investors consider when buying and selling securities.
ESG at the level of corporates essentially reflects companies' attempts to integrate environmental and social issues into the way they do business, into their business model, and into their strategy.
So a quick recap. E stands for environmental, S stands for social, G stands for governance. ESG investing means taking into consideration how a company's environmental, social, and governance performance will affect a company's financial performance, and in turn use that to determine investing in the company. According to a Morningstar Direct report, a record $45.6 billion went into the global sustainable fund universe in the first quarter of 2020. Interest in sustainable investing jumped to 85% in 2019, up from 71% in 2015. Bank of America predicts the money in ESG investing could rise to between $15 and $20 trillion because of changing demographics. ESG investing has its origins in a 2004 letter from former United Nations Secretary General Kofi Annan. He wrote to 55 CEOs of the world's leading financial institutions, inviting them to participate in an initiative that would bridge the gap between investors and important environmental, social, and governance issues. The group formed into what is known today as the Principles for Responsible Investments. Members are required to report their responsible investment activities each year. More than 2,000 money managers like BlackRock, Morgan Stanley, and JP Morgan have signed on. ESG had made its mark, but it still wasn't widely adopted by investors. Flash forward 16 years to January 2020. The CEO of the world's largest money manager, BlackRock, released a letter to its investors that stunned Wall Street. BlackRock CEO Larry Fink told other chief executives that climate change and investment decisions surrounding it would lead to a fundamental reshaping of finance. Fink wrote, "As a fiduciary, our responsibility is to help clients navigate this transition. Our investment conviction is that sustainability and climate-integrated portfolios can provide better risk-adjusted returns to investors. And with the impact of sustainability on investment returns increasing, we believe that sustainable investing is the strongest foundation for client portfolios going forward." Suddenly, every Wall Street CEO wanted to discuss how they were making profit and doing good at the same time. Sustainable investing can be confusing for some investors. For example, you can invest in funds or companies that avoid the tobacco, arms, and fossil fuel industries. You can also target investment toward companies that do good, like workplace equality or reducing carbon emissions. Those are just a few ESG strategies. Investors used to think that socially responsible investing would eat into a company's profit and competitive advantage. Now investors see it as an opportunity to identify potential risks or even disasters before they happen. The biggest ESG criticism has been that some companies use it as a marketing ploy.
These are useful statements. It's great marketing, but again, it's a lot of sizzle, no steak.
Companies make grand promises to become more inclusive or environmentally friendly, which opens them up to more ESG money and improves their public standing. But some companies don't end up following through on those promises. One early example, Volkswagen's emission scandal.
Volkswagen's emission scandal keeps shares in the red.
People were duped into believing they were buying a green vehicle that was not green.
Fines and settlements that Volkswagen has paid up to $20 billion, one of the most costly corporate scandals in history.
It's essentially about maintaining business as usual, but trying to tell a story or a narrative that exaggerates, let's say, your environmental and social commitments or initiatives.
There's been also a number of real cases where a company had accident, if you want, that the ESG ratings provider anticipated in a sense, and that has helped getting more recognition. So Equifax is a case where that particular company had a fairly major hack problem with data privacy and security. And as an example, we downgraded Equifax a year before the hack to the lowest level of our rating on the basis of them having already had a relatively bad track record of managing their data security, and on the fact that the company in that sector should actually have fairly robust practices in this area.
The practice of greenwashing has forced Wall Street to scrutinize companies.
The skepticism around ESG investing is warranted. There are companies that disclose information just for the sake of disclosing, and so far there hasn't been a lot of accountability in terms of stated goals versus progress towards the goals. How do you differentiate as an investor between a company that's talking the talk and a company that's walking the walk? And here, what we think we need to do is start tracking companies' achievements of the goals that they're stating in their corporate sustainability reports, etc. And that's one of the critical differentiating features when it comes to analyzing companies.
In Europe, laws mandate that public companies, asset managers, and pension funds must disclose environmental, social, and governance risks in their investments. The US doesn't have the same level of transparency. In the last 10 years, more companies in the US have begun to self-report their ESG performance along with their financial statements each year. Research firms, investors, and other stakeholders take the self-reporting data and other public information to rate the company based on a range of ESG data. Criteria can range from how they treat their employees to how sustainable their corporate culture is or how diverse their board is. Even if a company receives a high ESG ranking, it doesn't guarantee that the company will be profitable in the long term.
We know from research that companies that do genuinely understand and integrate these issues, not box ticking, not greenwashing, but actually integrating, in the long run, they are better performing companies, especially those that identify and improve on the financially material issues of their industry.
One of the things that we have found is that depending on the model that you're using, you might be getting very different estimates. So what do you do if a company, for example, is not reporting is gender diversity in the employee workforce? Or what do you do if a company is not reporting greenhouse gas emissions? Or what do you do if a company is not reporting lost time injury rates in the workforce? You try to estimate that.
So far, there's no single standard in place for ESG tracking that companies can all follow. Research firms like MSCI have been trying to help quantify the data and help investors make informative decisions. The firm has more than 1,000 MSCI ESG indexes, and provides ESG ratings for around 8,500 companies.
The ESG rating itself will look at different types of issue depending on where the company is operating, so the nature of their business. So if you take a mining company, issues about the environmental footprint, health and safety would be consideration that we would look at. In the technology sector, it would be more examples around data privacy and security. If we look at the retailer, we would look at the supply chain and how this retailer is managing their supply chain. So there's a range of issues, roughly 30 of them, that we monitor.
Over the past year, the iShares ESG MSCI USA ETF, one of the most popular ESG ETFs, has outperformed the S&P 500 by more than 4% as of June 22, 2020. ESG investing is becoming a bigger concern outside of Wall Street boardrooms. 87% of millennials and 64% of women agree that ESG plays an important role in their investment decisions.
There are three groups that show up as being most interested in ESG. It's millennials, women, and high net worth individuals. So essentially, millennials are the folks that are going to inherit and generate wealth over the next couple of decades. Women are increasingly heads of households and are making investment decisions for their households. And then high net worth individuals are the folks that control the largest proportion of assets today. So just millennials alone stand to inherit or create wealth in the US of about $80 trillion over the next couple of decades. If you just took that and you took a quarter of it, a fairly conservative allocation, $20 trillion is effectively the size of the S&P 500 today. And that's a proportion of assets that could potentially flow into ESG and impact investing over the next couple of decades.
The recent calls for further transparency from companies on their diversity and inclusion efforts has reinvigorated interest from the everyday consumer.
As corporate executives respond to the current crisis around racial inequality and civil rights, I think that they are implementing a wide range of approaches. Some of that involves corporate philanthropy, but I tend to focus more on what's happening inside the enterprise, as well as what's happening at the board level. That's really where the rubber meets the road. And that's really where corporate leaders actually have the most influence, if you will, within their own organizations. And so if they can't stand on the policies and practices of their own organizations, I don't think they really have the credibility, right, to use philanthropy as a substitute for getting diversity and inclusion and human capital management strategies right within their own organizations. You got to do that first.
Think about it. If you have a consumer company that sells primarily to women, but the board of directors is dominated by men, there's a disconnect between the management team and the decisions being made at the top versus who's actually buying the products. And this has actually been a very strong signal of weaker return on equity for companies that have a lack of diversity in their management and board of directors. Similarly, for social aspects like employee satisfaction, if you have a company within a competitive landscape, your number one asset is your skilled workforce. If your workforce is dissatisfied and likely to leave and go to a competitor, that's a risk to your bottom line and to your existential characteristics in the marketplace.
The disconnect between Wall Street and Main Street has grown more and more stark, especially with the global pandemic and demonstrations over racial injustice rocking America. As millions lost their jobs and thousands took to the street in protest, the stock market surged. But there's one silver lining. ESG investing is also set to surge in 2020.
While the market was quite volatile, what was very interesting is that investors were really flocking to ESG strategies. As early as 6 months ago, the focus was squarely on the E, right, and specifically on climate change and the investment implications of climate change. I think what has happened in the last 6 months, because of the COVID-19 crisis and because of the issues around racial inequality in the US and the ensuing global protests that have evolved, there's been a big focus on S and social issues as that relates to labor as it relates to employee safety, as it relates to the supply chain. I mean, a whole host of issues that were, I would say, not as much of a focus are absolutely front and center.
I would expect that ESG will be a standard option as opposed to one that you need to ask for. If your clients of a mutual fund or a wealth management organization. And the second element is full transparency on the ESG characteristics of funds, so that as an investor you feel comfortable that you know what you're buying in terms of ESG characteristics.
In 10 years, this will probably be much more embedded in the investment process. ESG investing won't be some carve out of the investment panoply, but every investor in the world will be armed with these new tools and these new data sets that will help them to make more informed investment decisions.